the Jet Setting Wealth Advisory Podcast, where your financial journey takes flight with David T.U. As an airline pilot and financial expert, David merges the aviation industry and wealth management to help you navigate today's complex financial skies. Each episode features expert insight, blending personal stories with essential financial strategies. We ask that you fasten your seatbelts and sit back as we prepare for takeoff. Our destination, your financial empowerment.
Hello, everybody. Welcome back to Jet Setting Wealth Advisory. I'm your host, David T.U. And today we are absolutely delighted to have Eric Lanning, who is an attorney, join us. He is a counsel at Frost Law and a highly respected authority in tax and estate planning. With over 2 decades of experience and advanced credentials in tax law, Eric specializes in taxation of insurance and annuity products, as well as sophisticated estate planning strategies designed for high net worth individuals and business owners. His deep understanding of wealth transfer, trust structuring, and tax compliance makes him a sought-after advisor for those looking to preserve and grow their assets in a constantly evolving regulatory environment. At Frost Law, Eric plays a key role in guiding clients and contributing to the firm's leadership in tax law and the strategies that they execute. In today's episode, we'll explore how Eric approaches these complex estate planning and latest trends in tax law and how affluent families and business leaders can help optimize this type of legacy planning. Eric, welcome to the show. Great to have you here.
Thanks, David. It's great to be here.
We appreciate your time. So let's get started. Let's start with your story. What led you to the legal field and what inspired you to focus on taxation and estate planning?
Couple of different answers there. From the legal field, from a young age, my dad would impart upon me some wisdom. My dad was a blue-collar guy, didn't go to college until later in life, but would always say, "You're too smart to do what I did. You're too smart to work with your hands." And I don't know if it was a friend or relative or someone of his, but he had this idea, you should be a lawyer. And that kind of stuck with me, and completed my undergraduate and went to law school, and that was it. As far as tax law, David, I really just kind of never really would have thought of it. It's not something I would have expected, but in law school, I had a few tax classes that I really enjoyed, got into an estate planning practice right out of law school, and ultimately went back and got my LLM in taxation, and really just wanted to focus on that because it's an interesting world. There are a lot of black and white rules in tax law.
Sure.
But the interpretation is sometimes anything but black and white. So I find it's intellectually,
a lot of grays.
Yeah, a lot of gray. It's intellectually challenging, and it's not boring by any stretch.
No, it isn't. You, at the beginning of the conversation, before we hit the record button, you mentioned the recent cases, a couple of cases that you have in regards to the airplanes. Can you elaborate and tell us a little bit more about that and what the result was?
Sure. Yeah. There were 2 recent cases. One involved an airplane. One involved actually a charter yacht.
Okay.
But similar issues in both. And I think this is interesting that we would come to meet each other at this time. On one of the cases, the airplane case, our firm was contacted by an individual who had been audited related to his business use of an aircraft. The IRS was asserting that his use was not sufficiently business related, represented more of a hobby usage, which may be familiar to some of your listeners. The question of whether something is business or personal use. The IRS had asserted that his usage was personal and had assessed a deficiency in penalties against the taxpayer. We picked up this case after the audit had concluded to take the client through the appeals process. And so what that entails essentially is writing what's called a protest, but essentially your ticket to the IRS Independent Office of Appeals. We prepared that protest after a somewhat lengthy process because these days nothing gets done quickly at the IRS. We were assigned an appeals officer and met with that appeals officer. And that process generally or that stage in the process, excuse me, is really when you get to understand here's where the appeals officer is at. They've read what the lower level of IRS, the exam report asserts, and what the position of the IRS auditor was. And then they read our petition or our protest and assess, okay, here's where the IRS is, here's where the taxpayer is. And the Independent Office of Appeals can look and assess what we call hazards of litigation. So they can give a realistic view of the question of if the IRS were to go to court, if the taxpayer were to sue the IRS and go to tax court or U.S. District Court, how likely is the IRS position to prevail? So in this case, the appeals officer had an assessment of the case that was favorable for our client or the taxpayer in certain aspects, but there were certain aspects where the appeals officer felt the IRS had a decently strong case and asked us to come back to him with some additional argument and support for our taxpayers' position. We prepared then a supplemental submission to the appeals officer who reviewed that and then came back to us with very pleasing to us, a full concession on the part of the IRS.
Wow.
Full concession from the part of the IRS. So once the appeals officer had reviewed our initial submission and then our supplemental submission relative to those various points where he thought the IRS position was a little stronger, he ultimately decided that their position, was too fraught with hazard to take to litigation and agree to a full concession.
Fantastic. So that was for the airplane, and you mentioned something about a charter.
Yeah. So a similar case, and you can think of this might apply with aircraft, it might apply with boats or yachts,
Okay.
where the IRS might look and say, there's potential that there's abuse there, right? It's an enjoyable aspect of that person's life.
Toy.
Yeah, it's a toy essentially, is what they would say, or they would say it's an entertainment facility, to use the more technical term. But similarly, in the other case, we again were retained by the client, after the audit had concluded, after a fairly large adjustment negative to the taxpayer was issued by the IRS. And we came in that case, and that case actually has had a deeper dive that might be more instructive for your listeners who are looking prospectively at how to plan and how to manage these activities. In that case, we prepared for the appeals officer a detailed view of this client's calendar. So the usage of this charter yacht, the usage in both sort of third-party charters, as well as the usage in certain sport fishing activities. And so we were able to demonstrate to the IRS the profit motive that existed throughout all activities, and then to demonstrate the appropriate business record keeping. And that was really important. So showing that the taxpayer intended for this to be kept separate from other business activities, intended to maintain and operate this as a business, was sensitive to profit and loss questions, was sensitive to how certain activities affected the success of the business. And through that, we were able to get a very large adjustment reduced down to a very small adjustment. And that really just acknowledged that in that particular case, there was some personal use of the vehicle. And from the IRS's perspective, a certain small percentage of expenses could not be deducted as business expenses. But in large part, and this is really the instructive part, through great record keeping, we were able to show and to substantiate, really down to the hours, I would say down to the 100%, the business usage versus personal usage, and really substantiate that for the taxpayer.
Fantastic. So there's two follow-up questions, and then we'll move on.
Absolutely.
First, can you give me either the type of aircraft that you had in that particular case, or the approximate value of the aircraft value, and also the vessel, the marine vessel, approximate the value, or what type of vessel was it?
Yeah, of course. So the airplane is a Cirrus SR-22T, so a single engine fixed wing, and the
vessel
is a 40 to 50 foot sport fishing yacht.
Okay. Is that Viking?
Yes, it'd be
Okay.
it's a Viking.
Okay, understood. All right. Fantastic. And could you give us what you were able, so the first one, which is the airplane, you were able to basically mitigate any additional taxation for that particular case, correct?
Yeah, so the challenge in these cases obviously is that a an individual operating a business related to an aircraft, for
Sure.
example, is going to be deducting certain expenses, including in large part the depreciation or depreciating the
Absolutely.
value of the aircraft. And so
Absolutely.
when the IRS looks at that and decides, that's not a business, that's a hobby, what they're generally doing is disallowing those expense deductions. And
Sure.
so in that particular case, because we were able to show that in fact the taxpayer was using this for a business purpose, was maintaining the appropriate records, and could demonstrate that, the personal use in that case was completely eliminated. There
Okay.
was deemed to be no personal use, and so all of that depreciation deduction was available to the individual. All the other expenses related to the use and operation of the aircraft were essentially approved by the appeals officer.
And the vessel, you mentioned that good record keeping. What was it? What were a couple of the things that you would like to share with the viewers in terms of good record keeping? What would your recommendation be for that?
In both cases, logs are really important. So usage logs. So in the case of a vehicle or a vessel or an aircraft where there is some personal use involved, which can be okay.
Yep.
When there is some personal use, that should be really notated,
Okay.
right? So business purpose, passengers who are with you on the plane, for example, on the
Sure.
aircraft, departure, destination, all the details you'd expect to see in a log.
Sure.
But good documentation of business purpose is really essential. And again, when there's personal use, that's okay, but it should be documented and it should be clearly shown that it's separate from the business use. To the extent that there are deductions being taken. If there is personal use that's documented, the individual might attempt to make a determination of what percentage of deductions would be appropriate based on the business versus personal use.
Fair enough.
It's a good
Fair
way to
enough.
look at it.
Fantastic. You mentioned also that you took over the case after the audit has been completed. So you were retained and you were hired to represent the IRS, or I should say, to represent the taxpayer.
Correct.
What is the difference between hiring you, an attorney, versus hiring, let's say, a CPA to represent their particular case?
I think that's a great question, and it probably depends, and I'll have a little bit of attorney bias in answering this
Sure.
question, but
Please do.
whenever I get that question related to anything, I tend to say accountants are better with numbers, attorneys are better with words. That is a general rule that I could probably pretty easily be proven wrong with respect
Okay.
to. But in general, our firm, Frost Law, Frost and Associates, has a history of what we would refer to as tax controversy. So representing
Okay.
clients in front of the IRS, whether that's through an appeals process or even earlier at the audit process, assisting individuals in setting up payment plans, individuals who are under threat of collection from the IRS. So we've got a long history of that and a lot of experience. And so what we were able to do is draw on that experience when representing these clients. Now, a CPA is going to have potentially that experience as well. And to be frank, in the vessel situation, in the vessel case, we did work closely with the CPA who had done a lot of the calculations, had done a lot of the record keeping. But it would be maybe the question I would, or the way I would frame it is, whoever someone is working with should have a good experience with advocacy in front of the IRS. Because again, the advocacy in both of these cases, I would say, really carried the day.
Fantastic. Thank you for sharing that. Let's move on. So, in your experience, you've been doing this for over 2 decades. What are some of the most common mistakes that you see business owners and high income earners make when it comes to tax planning or, in fact, wealth transfer, or I should say, tax mitigation?
Yeah. I think this is an easy answer in
Sure.
some sense, or at least my first answer, which is failing to plan.
Okay.
I have done a lot of estate planning in my career. I don't do as much now, but I still work with
Okay.
our estate planning team on issues. And one thing that I think estate planners roundly recognize is the I think the expectation on the part of some individuals, general wealthy individuals, but maybe across the board, that their kids or their grandkids or their whoever survives them will work it out or will get along or will resolve disputes to the
Sure.
extent that they don't need to answer those hard questions early, right?
Sure.
And there are a lot of reasons for that. I think we all want to believe in family harmony, and sometimes we don't want to make those hard decisions, and we don't want to feel like we're hamstringing our kids or grandkids and what they might expect or have to deal with in the future. But that I've seen more times than I can count disagreements among siblings, disagreements among aunts and uncles and nieces and nephews. So just
Sure.
difficulty in carrying out everyone's own impression of what grandmother or grandfather's wishes were. And so really the leaving things to chance or leaving things to best intentions, it can cause problems down the road.
Sure.
That's one of the big ones.
So would you say that would be one of the biggest misconception about estate planning, especially for younger entrepreneurs, where they believe just that everybody's got their different ideologies and just leave things to chance?
Yeah, I think so. And I think, what I think, particularly with younger clients that I've worked with and
Mhm.
some that we talk with on the non-estate planning side, just about kind of planning for growth in their business. Someone
Okay.
thinks they've got a moonshot on their hands. So how do we deal with that? How do we mitigate the potential capital gains impact that's going to occur at an exit in the future? This is all top of mind because that's what they're focused on right now. And the estate plan stuff doesn't seem timely because they think I've got time for that. If I'm going to live till I'm 100 years old, I don't need to worry about this right
Sure.
now.
Sure.
The things we talk about is number one, nobody knows how long, or how long it will be before that comes into play.
Yep.
And second, this is particular for people who are growing, right? Many things, whether it's in sort of capital gains planning or estate planning, many of those things can be done more efficiently now. For example, when business values are lower, when asset values are lower, when we have to use less of our transfer tax exemption, less of that now because assets are valued lower. So we can do that planning with assets at a lower value and get the upside, get the appreciation out of the taxable estate, out of the potential capital gains taxable context before that appreciation occurs. Failing to plan now, thinking there's time later, is probably maybe a broader category of that mistake.
Understood. Thank you. Let's talk about trust structures and entity formation.
Sure.
What's your guidance for entrepreneurs and family businesses trying to choose the right legal entity for in terms of tax efficient setups?
Generally, I think there's a lot of benefit to using an LLC structure.
Sure.
There's and this will depend somewhat on the type of business, whether this is something that's just done for family management or whether there's operation involved. We're still, even though we see a lower corporate tax rate right now, we've seen that since the Tax Cuts and Jobs Act of,
Yep.
of 2017.
17.
C corporation still in most cases is not going to make sense. And again, there are exceptions to this, of course, but using an LLC that's being taxed as a partnership or an S corporation with each of which has passed through taxation treatment are often more beneficial. Yeah, but again, it's one of the things that very brief anecdote. I
Sure.
have a colleague who's a CPA who came to me with a list of planning techniques that they thought were potentially applicable to a potential client that they were prepping for. And they
Okay.
said, I want to just give me 2 minutes on each of these, say 8 or 10 topics. And I said, what is the client married? Yeah, they're married. Do they have kids? Yeah, they have kids. What do they want to do? Sort of what are their goals? And the CPA was, I haven't met with them yet, but
Oh,
I'd like to be able to talk about these things. And I thought, well, how do you know if any of these things are going to be beneficial? A charitable trust is very beneficial for someone who is charitably inclined, but it's not
sure.
particularly beneficial with its restrictions for someone who's not. So to some extent, I punt a little bit on the answer. I think that pass-through entities tend to make more sense,
Okay.
but certainly there are situations where something like a C corporation might be very useful.
Okay.
How's
Thank
that?
you.
How's that
I,
for a
I like
non-answer?
it. I like it a lot. It just depends on the situation, but there's different paths to pursue, and it's dependent on each of the individual
Mhm.
and entrepreneur to make that decision. You, on the other hand, is to provide the proper advice and the guidance to try for them to be able to make educated decision.
Absolutely.
Many business owners hit a wall when trying to grow due to financial or their tax burden that they have triggered. How can they prepare ahead of time in terms of avoiding these type of cash flow pitfalls? Any thoughts?
Yeah, I think from the tax side, and this gets back to the planning issue, right? Working with a tax attorney and a CPA to understand and to model out what growth is going to look like, what potential exit events are going to look like. On the financial side, obviously, what capital needs there are. That's a little bit outside of my area, but certainly we definitely work with other professionals who are focused more on that. I think really just understanding what's potentially out there so that there aren't surprises,
Okay.
as simple as that sounds, is the best thing to do. And again, I keep hitting on this as well, to do it early enough. Oftentimes planning can be effective, but it's got to be done enough in advance. It has to
Okay.
be done enough in advance so that it's efficient from a value standpoint.
Okay.
So if we're talking about doing some capital gains tax planning to help shelter or at least delay taxation of appreciation, we want to do it when the asset has a lower value, when the business has a lower value, and not after sufficient appreciation has already occurred. It's not magic, right? So just the eye toward the future and planning and understanding that how growth works, how potential exits work, and really even understanding what a potential exit looks like. If someone wants to be in a particular business, wants to grow that business and operate it until he or she is ready to retire, or whether this is one step in the road, and working with advisors who have experience building businesses with clients in both of those contexts, really.
Okay. Great. Are there any creative or underutilized strategies that you would recommend in terms of tax mitigation or reducing tax exposure of and to protect assets, especially those that are not non on the average CPA's radar? Anything that you could share with us on that?
I think in different kind of situations there are different answers, and this may be on the average CPA's radar, but just from a tax mitigation standpoint, when we're just thinking about somebody who's trying to understand where to invest their funds, and you started off noting my experience with life insurance and annuity
Yes.
products, particularly variable products. I'm not a salesman, a life
Okay.
insurance salesman, but I have a lot of experience in that world. Those are excellent ways, as you and your listeners probably know, to
Yes.
be able to compound on a tax deferred, or in the case of life insurance, a tax free basis investment. For a business owner who's looking to make an exit from a business, depending on what their capital needs are, an old standby, but maybe not as frequently utilized as you might expect, would be an installment sale, right?
Sure.
The ability to delay the taxation over a period of time. This is really beneficial for someone who's exiting and has a very specific kind of understanding of when they're going to need capital and how much. And by the
Mhm.
way, they don't need it all right away. There are some strategies that we utilize, including something called the structured installment sale, which sounds
Yes.
like a scary thing, but it's not too scary at
Nope.
all, where we can deal with some of the normal kind of non-tax problems with an installment sale, right? The ability of a seller to be confident that buyer is going to make all the payments. So we can
Sure.
structure installment sales to give some clarity and some comfort to the seller without accelerating the taxation or otherwise messing with the integrity of the installment sale.
Fantastic. So at my firm, we do provide installment sale options as an exit strategy for tax mitigation. So this is something that would be very useful as a additional resource that
Yeah.
if your firm, of course, sets up the structure, the legal entity, and of course the documentation
Yep.
of setting this whole entire
Mhm.
installment sales and all the different entities that is needed to do this. So
Yeah.
fantastic. This is really fantastic. Entrepreneurs often pour everything into their business. As how do you advise them to balance reinvestments with building personal wealth and say their long-term security? Do you provide any of that type of advice?
Yeah, I think what we try to do when we're working with an individual is understand who their other advisors are and what their overall picture is. And within the Frost firm, obviously, we're a law firm, so we don't provide that sort of advice, but we do have in our network of firms that we work frequently with, wealth advisory firms. And so we're often partnering either with those or even with a client's advisor who we've never worked with before to understand what the whole picture looks like. Because I think that is a problem with what sometimes happens as a failure to communicate among advisors, right? And some of that is maybe led by the entrepreneur or the client in the sense that these are oftentimes very people who know what they want and know how they want to do it. And so they may say, look, I'll talk to the CPA, I'll talk to the financial advisor, I'll talk to the lawyer,
Right.
and then I'll synthesize all of that here. And that can work really well.
It
But
can, but
but yeah,
less energy.
yeah. And
Yeah.
so what I always like to do is understand, and not to repeat the kind of the example, but in the installment sale context, if we can work with a financial advisor and understand, okay, this is the capital that our client has available that can eliminate the need for him or her to look to the proceeds from the sale. So we can do planning
Mhm.
with that sale and not worry about our client coming to us 6 months later saying, it turns out I really do need that money down the road and can't do it. It's less of a suggestion, again, David, because it's a little bit outside of my world, but I think we always want to understand that the client is looking kind of broadly at their financial picture and is diversified in the sense that our planning strategy makes sense. And just to circle back as well, for a client who's going to do something like a restricted interest trust, a
Sure.
charitable trust or something like that, clients need to understand that one of the kind of fundamental things about tax planning or tax mitigation is that oftentimes you may not have direct access to what you would normally expect to have access to. So if I'm setting up a charitable trust, I'm putting money in that trust and I generally can't change my mind. I
Right.
can't come back and say, I really did want that Caribbean island that I was
After
looking
all,
for.
yeah,
So it's really important to understand that there are other resources available and understand how and when different resources become available. So that's again a very general answer, but the holistic kind of view of it with other advisors providing input, I think, is pretty key.
excellent. You mentioned just a few minutes ago the use of life insurance because of the tax efficiency and the compounding effect of the value that it can grow to. How can business owners use insurance strategically, life insurance strategically, as part of their tax or estate plan?
I think in a number of ways. From a pure personal savings standpoint, as your listeners probably know, unlike retirement plans, premiums paid for cash value life insurance are not deductible. However, they're also not limited in general. There
Right.
are obviously some technical limitations within a policy, but generally, if an individual wants to put money into a policy, they can do that. It will grow tax free. And then, again, as I'm sure your listeners are familiar, certain withdrawals from life insurance policies are tax-free return of premium. There's the ability to borrow, which is also tax-free from the policy. So that's helpful. Policies are useful in the business context, of course, to fund potential buyouts in the buy-sell context. And then on kind of the far end, the use of private placement life insurance can be helpful. That's a little more sophisticated, obviously, but in general, business owners can do some pretty creative things utilizing
Sure.
private placement life insurance with what we kind of refer to as private derivative transactions. But you can, yeah, there are, and this kind of gets back to the other thing. You can get very sophisticated with clients, but
Sure.
you've got to be able to put it into the bullet points because tax savings in a vacuum always sounds good, right? It always sounds good, but
Sure.
it's what we have to do to get there that sometimes is a challenge for clients. It's the whole spectrum, really, from
Okay.
planning.
So that was about life insurance. You mentioned also, and I, in the intro, mentioned a little bit about annuities. What type
Mhm.
of annuities can you tell us or elaborate a little bit more on how do you go about utilizing the annuities for
Sure.
to help the business owner and the client?
Yeah. Yeah. So in general, again, not being a salesperson, not being an annuity advisor, I'm not generally selling or recommending particular strategies with annuities for individuals. And as you and your listeners probably know, annuities are a little bit more restrictive at least under the tax rules as far as what you can do.
Sure.
You can't pledge them without a tax consequence generally. But annuities are fairly useful in the structured installment sale world, um,
Absolutely.
because in that world, without getting too deeply into that strategy, unless you want to, there's generally an intermediary involved, and that
Yep.
intermediary is holding sale proceeds, not under the control of our seller, but
Right.
holding those sale proceeds, and that intermediary is tasked with making the buyer's payments on behalf of the buyer. An annuity is a great investment in that context. And again, that's not
Yep.
a statement of a registered advisor, but generally, colloquially, it's a great investment because annuity payouts can be timed to match the payments that an intermediary is required to make under an installment sale.
Yep. Absolutely.
So
I am
they,
familiar with that. Yes.
yeah, so that makes a lot of sense. And in general, I think broadly, annuities, I think, can be useful tools for individuals a lot in much the same way as life insurance, from the standpoint that the growth is deferred as long as it's not removed from the annuity contract. So there is some deferred growth. You don't get the exclusion from income tax on the death of the
Right.
owner like you do with life insurance.
Right.
But annuities, as we were just talking about, have structured payout mechanisms that can be tailored to meet certain needs. And individuals can set up certain payouts for certain beneficiaries. You can almost create a pseudo spendthrift environment. So protecting a beneficiary, as we do sometimes in spendthrift trusts, by only allowing certain amounts to come out.
Sure.
The estate planner in me wants to say that's not the most effective way to do it. We want to do that in a trust, but annuities can be useful for that purpose as well.
Fantastic. So you mentioned this just a few minutes ago also, philanthropy, charitable inclination, charitable giving. How does all of this philanthropy and charitable giving play in smart tax and legacy planning?
I think the most obvious way is for a client, or the fact that a client has the ability to take a charitable deduction. That's the maybe the
That's a
most
big one.
that's the big one. That's the most direct way. And there are obviously multitude of planning options, from making contributions to a public charity to setting up a donor advised fund, which is a little more
Sure.
control, all the way to establishing a private foundation or even operating a public charity. And those have their own sort of deductibility limits. When you're operating it, there are different considerations that come into play.
Okay.
But obviously, the biggest headline there is the ability to take a deduction. The caution that I have, and this is leads back to, I guess, the kind of the message or the point I keep bringing up, is that the client needs to be aware of everything that entails, right? We see, unfortunately, situations where clients are operating charitable organizations themselves and don't necessarily understand that it's a bright line rule that you can't commingle personal and charitable funds. It's not like running a for-profit business, right?
Absolutely.
Everything has to be documented and laid out. If you,
Segregated. The
yeah,
accounts, all the
segregated.
assets segregated. Yes.
Exactly. And if you're doing things like taking compensation from that organization, or taking a management fee for certain activities, or even making a loan to or taking a loan from that organization, there are really steep penalties that will apply if you do it wrong. And so that on the operational side, that can be a real challenge.
Okay. What tools or professionals should every serious business owner have on their financial dream team?
I kind of inconsistent with my prior stated bias for attorneys. I think very knowledgeable and business savvy CPA is
Okay.
probably number one,
Okay.
followed closely by an attorney, a tax and or business attorney, preferably someone who's got experience with both, an advisor who may or may not also be the insurance expert
Sure.
is helpful, but a good financial advisor, someone, again, who has experience with business owners, who has experience with alternative investments. And I don't mean that as a particular asset class, just
I get it.
generally
General. Yep.
the
Under the
ability
umbrella.
to look at different investments and understand them. I think that's key. But top of the list is that CPA who has that kind of in the big four world. I think they call it the national office, but that national office CPA, the one who understands the tax issues beyond the tax return.
So are there any upcoming tax law changes, estate planning trends, or regulatory shifts that business owners should be aware of right now?
Yeah, so not that are immediately, imminently on the horizon. There's now what we do know, and I mentioned the Tax Cuts and Jobs Act
Sure.
previously, passed in 2017 under the first Trump administration.
Yep.
Now that we have the second Trump administration in place, obviously, no surprise that they're seeking to see how to extend the impact of that. The tax
Or make it permanent.
or make it permanent,
Yep.
correct. Just very briefly, and this is only for the nerdiest, but the original Tax Cuts and Jobs Act was passed under something called the budget reconciliation procedure. As most of the tax acts in the 21st century have, I think all of them have been passed under budget reconciliation. It only requires a simple majority. The issue with that is it's a budgetary procedure, not a tax procedure. And so there are there's a certain analysis and economic scoring that has to happen. And if the changes in the tax law contribute to an increase in the deficit, this is very shorthand, but in the budget window or the second budget window, then those rules have to sunset. So think about early 2000s, the Economic Growth Tax Recovery Act, I believe Tax Reconciliation Recovery Act under the Bush administration. That was famously when the estate tax was repealed. But most people will remember it was only repealed for 1 year. It phased out, and then it was repealed for 1 year, and then it came back to its original, $1.5 million exemption, I think it was. And that's because again, the budgetary aspect of the law didn't score well enough to be permanent. So what they'll need to do probably is take a look at that, take a look at how they can tweak the provisions, which ones can be made permanent, which ones can't, in order to pass that budgetary scoring hurdle and make those things permanent. We see that out there. Our firm, we haven't really talked about this, has done a lot of work over the years, something called the Employee Retention Credit.
Sure. ERCs.
ERC, as astute listeners will know, ERC ended, if you will. It's not a program like PPP, but it's the availability to amend returns and claim the credit ended with the end of the 2024 tax filing season, but we continue to see claims that have not been paid. So there could be legislation. There actually was legislation passed by the House of Representatives last year related to certain aspects of the ERC that we could see that coming back, which would have an impact on that segment of our clients. The estate tax exemptions, so maybe more germane to our conversation, is set with the expiration of the TCJA to be greatly reduced, more than cut in half
Right.
after 2025. It's not unlikely that we'd see some activity there as well.
Okay. Finally, where can people, or I should say, if our listeners were to walk away with just one piece of advice from you today, what should that be, or what would that be?
That's a great question. And it depends on the listener, but if I could take it back to the heart of what we're talking about here, for a business owner, particularly a business owner in kind of what we referred to a little bit earlier as the fun types of businesses, really to make sure you're running your business like a business.
Okay.
That's not meant to
Excellent.
be pejorative. It's not meant to be judgmental, but really what we've seen when we see friction in the tax world, what helps to get past that friction is the business owner who's got everything documented, who's running things correctly, who's not commingling personal assets. And again, it's not that these are rampant, David. It's just that these are the points. And to the extent that a listener hears this and says, yeah, I already do that. Tell me something I don't. Tell me something I don't know. I would simply say that's good and keep doing that, because in the event that the IRS starts asking questions, those are the kind of things that we want to be able to demonstrate to them, showing that you're doing things the right way.
Sounds good. Where can people find you, connect, or learn more about you, Frost Law, and your insights in tax and estate planning?
Probably the best place is our website, which is askfrost.com.
Okay. And that'll be at the bottom of the viewers, at the
Awesome.
bottom of the screen. And
Yeah.
go ahead.
Yeah, I was going to say, and people can find me on LinkedIn as
Okay.
well if you're interested in reaching out and having a conversation. But yeah, Frost Law is probably askfrost.com would be the best resource, best way.
Fantastic. And do you have an email that we would like to provide to the viewers and listeners?
Sure. Yeah. It's my name with a period in the middle. So eric.lanning@askfrost.com.
Okay. And Lanning is Lanning.
Yeah, ERIC.LANNING.
At frostlaw.com.
Yep.
Fantastic. And for the viewers,
Askfrost.com.
I'm sorry, at askfrost.com. It will be at the bottom of the screen for viewers. And any final closing statements?
No, I've really enjoyed talking with you today, David. Thank you
I
very
did
much
too.
for the invitation.
Eric, thank you so much for joining us and sharing your inspiring journey from the beginning years all the way to the current practice that you have in tax law and becoming a trusted advisor for high net worth individuals and business owners, navigating the complex tax and estate strategies. And again, if you like to learn more about Eric's work and Frost Law, it is again at the bottom of your screen. My name is David Yu, airline pilot, founder, and wealth advisor at DTY Wealth Planning Solutions. In today's conversation, if you found today's conversation to be valuable, please don't forget to subscribe, give us a thumbs up, and leave a review, and share this episode with others who are serious about protecting and building their long-term wealth. Until next time, stay the course, think strategically, and continue building your wealth with confidence and purpose. See you next time.